WP Carey stock is up 16% year to date, which is really surprising since the overall market is down quite a bit after recent events. And looking at the recent earnings, we also don't see phenomenal numbers or anything. As a matter of fact, they missed on FFO big time. But this company is changing quite drastically in the recent years. Hence why the dividend scorecard is also showing negative growth numbers. But more on that later in the video. First, let's dive into the most recent earnings and do a fundamental analysis. By the end of this video, I will show you my 3 price targets. As we have seen a second ago, WPC missed on FFO but beat on revenue. Looking at the revenue reported for the 4th quarter, we see that this is actually down a little bit year over year. But it is up slightly quarter over quarter. Expenses are down drastically year over year. But due to a gain on sale of real estate last year, it looks like the net income is down. Well, it is actually up if you don't take this into account. EPS is down drastically as a result. Of course, this doesn't look that great, but I'm not worried to be honest, as previous quarter and year over year numbers are impacted quite a lot by events. Looking at the FFO and AFFO, 2 of the most important numbers for REITs, we see that FFO is up quarter over quarter, but down significantly year over year. The AFFO is looking a bit better, with a small increase in both cases. Taking a look at how the company is structured, we see that in total WPC has over 1550 properties across 355 tenants. North America is by far the biggest segment with 67. Europe is getting bigger and bigger with 33%. The WALT, short for weighted average lease term, is reported at 12.3 years, which is a great number, and occupancy rate is at 98.6%, also looking really good. Taking a look at the individual tenants, we see that the top 10 tenants only represent 19.3%, which is again looking really good. The biggest tenant is Extra Space Storage with 2.7% of the total ABR. I prefer a maximum of 10% here, so that is again looking really good. Taking a look at the property and industry breakdown, we see that industrial is the biggest segment with 36%, and warehouse is sitting at 27%. And I think these 2 property types are very promising for the future. Looking at the industry breakdown, we see that retail stores is the biggest with 22%. Nothing that worries me a lot here. And one of the more important numbers with REITs is the net debt to EBITDA. You want this number to sit between 5 and 6.5. As of right now, it is reported at 5.5 times, looking really good. The credit ratings are reported at B+, which is not too bad, but I prefer A credit ratings. And now that we know a bit more about the company, it is time to do a fundamental analysis. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community. And to talk about stocks. It's completely free, so don't miss it out. Let's continue with diving into the fundamentals. WP Carey is a 13.87 billion market cap company. PE ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. And right now it is sitting around 14.38, indicating they might be undervalued. Later in this video I will show you my 3 price targets for WP Carey stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 1.6 billion. And in this graph we see that revenue went up in the long run. To me this looked really good. However, there was a period of revenue that was going down. Most recently it is stabilizing. We see that margins are going up in the long run. This also looks really good to me. especially with the revenue going down a bit in the recent years. You want the margins to increase. However, the net margin is going down recently as well, something to keep our eye on. EPS is going up in the long run. It is not always steady and consistent, but that's very common for a REIT. Analysis expect that in the coming years EPS will slowly increase, nothing really special to mention here. For the revenue it is looking pretty interesting, with some decent mid-single-digit growth numbers in the coming years, but from 2027 on it is expected to see much higher growth numbers. Return on assets is sitting at 2.6%, which is a low number, even for a REIT. Return on equity is looking pretty decent. And the most important number here, return on invested capital, is sitting at 3.2%, which is again a low number. But it is slightly higher versus the 5-year average, so that's the silver lining. Current ratio is at 1, which is a great number. Nothing really special to mention here. And right now WPC has 8 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. WPC had 640 million in total cash, so they can't pay down a big chunk of their total debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up and down a lot, so this is something to keep your eye on as well. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 5.8%, which is a great number. Annual payout is at $3.52 and payout ratio is at 73%, which is right around the 75% average for REITs. There are no growth streaks since they cut the dividend recently. And in here we see the dividends paid in the recent years. In 2023 the company decided to change a few things drastically, and also did a dividend cut as part of the business was gone. I think to this day this was necessary for the company in the long run. From there they slowly increased the dividends again, so to be honest I don't mind that much, since the company is much healthier right now. In this graph we see the expected dividends in 2025, 2026 and 2027. Of course this is an estimation that can be highly impacted by results, but it gives you a rough indication. It is expected to slowly increase from here. And overall these dividends look really interesting to me, but how about the historical returns? I decided to compare WP Carey stock with the overall market, in this case the S&P 500. On the 5-year chart we see that WPC had a 40% return. And keep in mind this is including dividends. The S&P 500 is sitting at 150% return, beating WPC big time. On the 1-year chart it looks way different, with WPC returning 19%, while the S&P 500 is sitting at 12%. On the 6-month chart it is pretty interesting, with both having a similar return. On the 1-month chart it is the S&P 500 who's underperforming WPC one more time. The interesting part is that the S&P 500 is climbing again, while WPC is falling. So bottom line, WPC underperformed the S&P 500 in the long run. But could this be the perfect time to buy WPC stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 4, 6 and 8%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 30, 33 and 36. And for the free cash flow margin, I'm putting in 66, 68 and 70%. For the PE ratio, I'm putting in 20, and for the price to free cash flow, I'm putting in 7, 9 and 11. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now, WPC stock is around $62 to $63. I hit analyze, and we see a lot of red numbers. And since this is a REIT, I'm only focusing on the discounted cash flow value. We have a low price target of $44. We have a mid price target of $57. And we have a high price target of $74. And to me, the mid price target is the most justified here, indicating that this stock is overvalued right now. Which price target do you think is the most justified here? Let me know in the comments down below. My final conclusion on WPC is that it is an interesting company that drastically changed its business. It has been a while now since they did that, but to me it looks like they are not quite there yet. Looking at the fundamentals, I think everything looks pretty decent. However, there are a few concerns, such as revenue growth and the fact that free cash flow is not steady and consistent at all. Looking at the dividends, I also do get really excited. The yield itself is pretty high, and growth is back on track. However, the lack of growth in revenue and FFO is concerning me a little bit in the long term. Looking at the valuation, I think the stock is overvalued, but also because they aren't recovering that great so far. And as of right now, I do think there are better REITs out there that could be bought. So for now I'm skipping this stock, but I will keep analyzing them from time to time. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and it did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.